wish it weren't so, but I think that's a reality, and I reevaluated that in the light of certain things that were going on. Charlie?
Well, my view is that Warren ought to feel comfortable if he wants to.
Forget about some low-value investment options. Famed investor Warren Buffett's Berkshire Hathaway is shaking things up, buying into the Magnificent Seven. Tech giants like Apple and Tesla, worth a whopping $13 trillion combined.
The big thing is how our businesses do and what we get to add in the way of businesses over time. And we can add them through marketable securities. I mean, we own 5.5% or a little over percent of Apple. It's probably the best business I know in the world. And we own 5.5% of it.
This surprising move puts Berkshire in a quarter of the S&P 500. But there's a twist here. Buffett recently sold some Apple shares, which was his initial tech play. Is the Oracle of Omaha changing course, or is there a bigger strategy brewing? And why Apple? Let's find out. Apple.
They shouldn't buy in their shares at all unless they think that they're selling for less than they're worth. And if they are selling for less than they're worth and they have the money and they don't see an acquisition that's even more attractive, they should buy in their shares. And I think that that's because I think it's extremely hard to find acquisitions.
Now, let's be clear. Berkshire Hathaway hasn't abandoned Apple entirely. In fact, just last year, Buffett publicly declared Apple a better business than any other company Berkshire owned.
I mean, we own 5.5% or a little over percent of Apple. It's probably the best business I know in the world. And we own 5.5% of it.
Despite the recent sale, Apple still makes up a whopping 43% of Berkshire's $372 billion stock portfolio.
Buffett, he owns 887 million shares in Apple, which makes up 42.78% of his stock portfolio.
That's a significant chunk of change and a strong signal of Buffett's continued belief in the company's potential. So why the trimming? Analysts like Jordan Klein at Mizuho speculate that Berkshire might have continued selling Apple shares after the official reporting period ended. This could be due to concerns about slowing iPhone sales in China, a crucial market for Apple. Additionally, the recent implementation of the Digital Markets Act, or DMA, in Europe throws another wrench into the mix. This act could potentially hurt Apple's revenue by requiring them to allow third-party app stores and payment options on their devices.
Today, the Commission has decided to open its first non-compliance investigations under the Digital Markets Act. There are in total 5 of them. Our 5 investigations, they concern Alphabet, Apple, and Meta.
And if those are speculations, when can we know for sure? Well, we won't have a definitive answer on Berkshire's Apple activity until May 15th. That's the deadline for Berkshire to disclose their first quarter trading activities in a public filing. In the meantime, investors should ask themselves a key question. Is Apple a good investment at its current price? Apple boasts a powerful brand that inspires immense customer loyalty. This brand authority comes from a combination of sleek hardware and user-friendly software that creates a unique user experience. The more Apple devices a consumer owns, the more entrenched they become in that ecosystem, further solidifying Apple's hold.
Everyone, we've got to track Apple this morning, ticker symbol AAPL. Once again, a $3 trillion market cap company. The tech giant surpassed the threshold for the first time since August of this year and is on track for its best yearly performance.
This translates to significant pricing power. iPhones, for example, cost on average 3 times more than the average Android phone. This brand loyalty has propelled Apple to the top of several consumer electronics categories. They were the global leader in smartphone shipments last year and held top spots in tablets, smartwatches, and even personal computers. However, Apple isn't just about selling devices. They've also developed a robust ecosystem of services to further monetize their massive user base, which recently surpassed a staggering 2.2 billion devices. While Apple's brand and loyal fan base are undeniable strengths, their recent financial results haven't been stellar. The first quarter of their 2024 fiscal year saw a meager 2% revenue increase to $119.5 billion. Solid performance in their services segment was offset by declining sales of iPads and wearables. However, there were some bright spots. Services revenue grew strongly, driven by advertising, streaming video, and cloud storage. Apple has managed to expand its gross margin and increase earnings per share through share buybacks and the growing importance of its high-margin services business. One potential problem not reflected in the headline numbers is the significant drop in China sales. Apple's sales in this crucial market fell a concerning 13% in the December quarter due to stiff competition. This trend appears to be worsening, with Counterpoint Research reporting a 24% decline in iPhone sales for the first 6 weeks of 2024.
Very much under pressure, especially in China. This morning, we got this new report from the research firm Counterpoint, and the big headline number here, iPhone sales in China down 24% year on year for the first 6 weeks of 2024.
While Huawei, a major competitor, saw sales surge by a staggering 64%. While Apple CEO Tim Cook remains very optimistic about China over the long term, investors should monitor the situation closely. So, we've established that Apple boasts a powerful brand, a loyal customer base, and a diversified business model that goes beyond just selling iPhones. But how does this translate to future growth prospects for investors? Here's where things get interesting. Analysts at Grandview Research predict steady growth in the consumer electronics market, with an annual increase of 6% projected through 2030. That's a healthy baseline for Apple, but the picture gets even brighter when we consider specific segments where Apple holds a strong position. Mobile application sales are forecasted to surge by 14% annually. Mobile wallet revenue is expected to grow at a staggering 28% each year. And digital ad spending is on track to compound at an impressive 15% annually during the same period. Why are these specific areas important? Because they represent significant opportunities for Apple's future. The App Store is a major contributor to its services revenue, currently accounting for roughly 1/3 of the total, according to the Wall Street Journal. Apple is also a rising star in the digital advertising space, boasting some of the fastest growth rates in the US. Let's not forget Apple Pay, which is the most popular in-store mobile wallet among American consumers. Taking these factors into account, Wall Street analysts generally expect Apple to experience consistent growth in the coming years. Their estimates project a 5.8% annual increase in sales over the next 5 years, with earnings per share climbing even faster at an anticipated 8.3% annually. This stronger bottom line growth rests on two key assumptions: a continued rise in the services segment as a proportion of total revenue, and Apple's ongoing stock buyback program. However, despite these promising growth projections, there's another side of the coin. Apple's current valuation, sitting at a hefty 27.4 times earnings, appears expensive compared to the consensus estimates provided by Wall Street. In simpler terms, you're paying a premium for the potential future growth. Furthermore, there are some potential roadblocks to consider. As we mentioned earlier, the recent slump in iPhone sales within China, a crucial market for Apple, raises concerns. This trend seems to be gaining momentum, with Counterpoint Research reporting a concerning 24% decline in iPhone sales for the first 6 weeks of 2024.
Very much under pressure, especially in China. This morning, we got this new report from the research firm Counterpoint, and the big headline number here, iPhone sales in China down 24% year on year for the first 6 weeks of 2024.
At the same time, their main competitor Huawei saw a remarkable 64% sales surge in the same region. Adding another layer of uncertainty is the recently implemented Digital Markets Act in Europe.
Now, we've been expecting to hear about how Apple was preparing for the DMA since the law went into effect just a few weeks ago. In Apple's case, part of it is they're required to allow these third-party app stores and open up other parts of the phone to third parties.
This act could potentially hurt Apple's revenue by requiring them to allow third-party app stores and alternative payment options on their devices. While CEO Tim Cook remains optimistic about China and the long-term impact of the DMA remains to be seen, investors should keep a close eye on these developments. Apple remains a powerful brand with a loyal following and a diversified business model. The future holds potential for growth, particularly in the mobile app, mobile wallet, and digital ad sectors. However, the current valuation might be stretched, and potential headwinds like declining China sales and the DMA create some uncertainty. So, should you invest $1,000 in Apple right now? The decision ultimately rests with you, but here's some food for thought. The Motley Fool Stock Advisor Service, a well-respected resource in the investment world, recently identified their top 10 stock picks for investors, and Apple wasn't on the list. This suggests there may be other companies with more competing investment opportunities at this time. But why then does Warren Buffett invest in the Magnificent Seven again? Well, we've explored Apple's potential for growth and the reasons behind Berkshire Hathaway's recent trimming of its Apple holdings. But here's an interesting twist. Even with the current tech climate, there's a way for investors to benefit from the Magnificent Seven without the risks associated with picking individual stocks. This approach aligns perfectly with the investment philosophy of the legendary Warren Buffett himself. The Oracle of Omaha isn't just about cherry-picking individual stocks. He also leverages a powerful tool: index funds. In this case, Buffett has gained exposure to the Magnificent Seven through his positions in two specific funds, the SPDR S&P 500 ETF Trust, or SPY, and the Vanguard S&P 500 ETF, or VOO. Speaking of index funds, what exactly are they? Index funds replicate the S&P 500, which monitors the top 500 publicly traded U.S. companies. Their simplicity lies in this mimicry. As the economy changes, the S&P 500 adapts its holdings, currently favoring the tech sector, constituting 30% of the index. Remarkably, the Magnificent Seven leading tech giants hold significant positions within this 30%. This means that by investing in these funds, you're essentially investing in these major players without having to individually select and manage their stocks. It's a convenient way to gain exposure to a diversified portfolio of some of the biggest and most successful companies in the U.S., all without the need for active management or expertise in stock selection. So, by owning shares in these index funds, Buffett gets a piece of the pie from these high-performing tech giants. But with a crucial difference, he's not heavily invested in just one or two companies. This is the magic of diversification. If one tech company stumbles, the impact on the overall portfolio is lessened because the fund's performance is tied to many different stocks. This approach significantly reduces risk compared to putting all your eggs in one basket. While Buffett is renowned for his stock-picking prowess, he understands the value of index funds.
Yeah, I would say that in terms of the index fund, I would just take a very broad index. I would take the S&P 500 as long as I wasn't putting all my money in at one time. If I were going to put money into a index fund in relatively equal amounts over
They offer exposure to a broad range of companies, including some he might not have chosen individually. Combined, these companies have a strong track record of boosting portfolio performance over the long haul. Just look at the historical performance of the S&P 500. Even after periods of decline or bear markets, the index has always rebounded and reached new heights. So what does this mean for you, the everyday investor? You might already own shares in some of the Magnificent Seven, or perhaps you're more cautious and have steered clear of high-tech stocks altogether. Either way, if you're looking to invest, consider following Buffett's lead and exploring S&P 500 index funds. This type of investment closely aligns with Warren Buffett's renowned philosophy, which extends beyond this personal portfolio to benefit regular investors like yourself. In his widely respected 2013 letter to Berkshire Hathaway shareholders, Buffett famously advocated for non-professional investors to own a cross-section of businesses that in aggregate are bound to do well. He further emphasized that a low-cost S&P 500 index fund will achieve this goal. By echoing Buffett's sentiment and investing in index funds, you're essentially following his advice to diversify your investments across a broad spectrum of successful businesses. This approach not only simplifies your investment strategy, but also aligns with Buffett's long-term belief in the resilience and growth potential of the overall market. Thus, investing in index funds reflects a prudent and proven method endorsed by one of the most successful investors of all time. The bottom line? You don't need to be a tech guru or an aggressive investor to benefit from the potential of the Magnificent Seven. An S&P 500 index fund is a versatile investment that caters to a variety of styles. By following Buffett's approach, you can gain exposure to the promising future of the tech giants while keeping risk to a minimum. What do you think? And are you currently investing in one of these giants? Share your thoughts below and subscribe for more. See you next time.